Esther George, the president of the Federal Reserve Bank of Kansas City, joins us now here in Jackson Hole, a beautiful setting. Thank you for having us and for joining us.
Good to have you here.
I want to just start with something. You gave a speech recently to a commencement class, and you talked about some of the principles for success. The speech was called Lessons Learned, and I thought that this could apply to the Federal Reserve given the last 9-10 years of policy. But be prepared,
Yes.
Be flexible, be brave, be humble, be grateful. And then you concluded quoting John Adams, and you said, we can't guarantee success, but we can deserve it. So let me start with the Federal Reserve. Given what we've experienced over the last 9 years with quantitative easing, does the Federal Reserve, has it gotten success, and does it deserve success? Because we're at a crossroad now and we have to change the policy.
Mm-hmm. Well, so the committee is very focused on doing right by the economy. So every person around that table approaches it with the intentions of success. We all bring different judgments, experiences to that debate. And so in the case of QE, I think we can't say today, was it successful? I think these are long-term issues, and until we return to something that's more normal or is successfully unwound, I'm going to withhold judgment on whether we've achieved success.
Well, let's talk about something, though, that the Fed has done successfully, and that would be employment. I mean, unemployment right now is roughly 4.3%, but there's a problem on the horizon, and you seem to be concerned, as are some of your colleagues, that wages are not growing at perhaps the kind of pace they should, given the tight labor market.
So I'm delighted to see the job market move where it has. That's given many more people important access to jobs and to wages. I'm less concerned about the level of wages right now because we're in a 2% growth economy. And wages are staying ahead of inflation right now. That gives the consumer more purchasing power. And so I think we're in a good place right now. What we can't do is keep trying to look for current information around inflation. So if it's not 2% today, to somehow delay. I think you have to rely on a forecast that says it looks like we're moving in that direction and continue on the path.
But a lot of your colleagues and you have raised the issue of how we measure inflation. And are we in 2017 measuring it accurately? Perhaps the models that used to work aren't necessarily serving us now. Is there an effort at the Fed to come up with new ways to measure not only productivity in the economy, but whether the 2% inflation target is something that we should discard or keep?
Well, I think there's a lot of questions about how you measure many things. That's why one of the things I like to do are talk to real people in the economy. Whether that's our board of directors, whether that is getting out and talking to business leaders, what you're really trying to figure out is what are leaders experiencing today? How are they making decisions 6 months, 12 months out? That combined with the data you have generally give you a sense of how the economy is moving. So I think it's important that you take both what you hear in the real economy as well as the data that you see in trying to shape a judgment about where the economy is moving, and that includes inflation.
Well, let me talk to you about the real economy, because even you, back in May, gave a speech in which you talked about the fact that historically, I think going back at least to 61, the growth should be around 4.1%, and we're averaging about 2%. Right. And why? Why aren't we growing at 4.1%?
It's a great question, and you'll see a lot of people trying to figure out what is going on here. I suppose the bits and pieces that we hear, whether it's too much regulation, whether it's a change with technology, whether it's any number of factors people are trying to piece together. Those are worth studying. We should understand that. In the meantime, 2% growth has allowed a lot of people to get back to work and brought that unemployment rate down. So it's a good sign.
But this issue that your colleagues have been speaking about of late with productivity, I mean, we are in a different economy today than we were even just 8 years ago.
Certainly.
So how does something, I call it the Amazon effect, where you have a huge company pushing down prices, does it have an impact on inflation to the degree that the Fed might have to start looking at different ways to measure that?
I'd be very open to that, and I think we should be open to thinking about how the economy's changing, and that maybe our traditional measures are going to have to change at some point. That's a challenge when you're looking to a forward-looking monetary policy. So you have to look at these things both in real time, both in a long-term sense. But I suspect what you're saying is right. We do see a different economy unfolding in many segments.
And a lot of the future is contingent upon the policy that comes out of the committee. When we talk about inflation, there's a possibility that the Fed, the expectation is there'll be one more rate increase this year. Could you see an argument as to why that may not be the case?
Well, there can always be an argument. We can get hit with shocks. The data could unfold in a way that creates some question. So I can imagine any number of things that might, but until you have some evidence, until you know and build that into your forecast, you're obligated to look to the long run. You have to rely on a forecast because you know your decisions today operate on a lag. So that's the challenge for policymakers, and that's why this policy has been to move gradual. And I think that's been right, a gradual approach, but to continue to move forward.
Is there anything that you see, however, right now that's a red flag that should say perhaps the Fed should pause on normalizing monetary policy at this point? Previously you said no, but I'm curious if that's changed in the last few months.
I don't think it's changed today. Now I'll be putting together a new forecast as part of the dot plot for the upcoming September meeting. I'll reevaluate how I look at all that. But we look at many things. One of the things our models don't incorporate very well are financial factors like financial stability and asset valuations. I don't know if there's anything there that monetary policy could do or not do, but there are many variables you have to incorporate into that forecast. So
I know the investors watching want me to ask you, will we get that next increase in interest rates in September?
I don't know that.
So you all are sitting around the table?
Until we're all, and it's true. We really do come to those meetings, and for myself, I try to keep an open mind. I come with a set of views. I come with some analysis, the preparation that you referenced. I try to do that, but also listening very careful. And it's really only at the end that vote will determine how people felt about the discussion they heard.
The other issue that not only investors but average men and women in the United States are looking at the Fed is the unwinding of the $4.5 trillion balance sheet. And we know that the Fed has no plan to do this quickly and also to go back to $800 billion as it was before the financial crisis. But the expectation is September, and the Fed has prepared us, the committee has prepared the country for the beginning of this. Will it begin in September?
Well, I think that'll be a discussion. Again, you've looked at the past meetings and how the committee has begun to prepare for and talk about it. And the last meeting, we indicated relatively soon. So it certainly is time to talk about that, in my view, and talk about the start of that process. And I think the economy is in a position where we should. Previously,
though, you had said sooner rather than later to begin that process. You still believe that?
Yes, I might have been happy doing it sooner rather than later.
You were actually opposed, wasn't it, in 2013 to the third QE? Yes. Do you think that was the right decision to be opposed to it then, or do you think it played out correctly as to where we are now? Well,
I'm still comfortable with the way I viewed it in 2013, and as I said, it will be some time, I think, before we know. Was that the right way to look at it, or did the world turn out in a different way? And I don't think today is the day to decide that.